Julia, your thoughts on the session today?
Another great session for the Australian share market, and you could call it the Larry Summers effect on the market. The fact that we did see Larry Summers dropping out of the race to be the chair of the Federal Reserve had a positive impact on risk markets. We saw the Aussie dollar rising, the US futures up 1.1%, and the Aussie share market reaching the highest level that we've seen in 5 years at 5,266 points. In fact, it's a fourth consecutive day now that we've spent over 5,200 points. So the market looking pretty comfortable here, and once again those growth areas that outperform the energy, the materials and the industrial sectors. In fact, it was green pretty much all across the market. In fact, if I bring up a market map, you can see that it's mostly green across the board. The only sectors actually to finish in the red were our two smaller sectors. There's a tiny corner down here, and that's the utilities and the information technology space. But all in all, another gain for the Australian share market, another 5-year high reached earlier on for the market, and now watching the US stock market to see if the momentum continues into tomorrow.
Among some of the big institutions, I mean, is it as clear-cut as yes, they're going to taper?
I think if we have a look at the views across the market, there are quite differing views. So it's really difficult to guess right now. If we have a look at Bank of America Merrill Lynch, they're putting a 55% chance and no taper in the month of September. So that's their base case scenario. And then they put a 30% chance that we will see a small taper, that's $10 to $15 billion, and a 15% chance that we'll see a large taper, which is considered $20 to $25 billion. And then if you move over to Credit Suisse, their favourite scenario is that we'll see $20 billion worth of tapering, $10 billion from the $45 billion MBS side that we've been seeing, and $10 billion from Treasuries. And the second favourite scenario is a $15 billion taper with $5 billion off MBSs and $10 billion off Treasuries. So really, I think the market is guessing at this point. And the market does seem to think that we will see at least a small taper to see in, and I think that's partly been priced in. If we have a look at the impact that this is going to have in terms of markets, we only have to have a look at the reverse of what we saw during quantitative easing. And if we have a look at during QE1, we saw the Aussie dollar rising by 26%. QE2, we saw the Aussie dollar rising by 9%. And of course, gold prices went absolutely crazy. QE1 gold prices were up 73%, and during QE2 they were up by 11%. So if we do see tapering, we are expecting to see a longer-term trend that does reverse those moves. So that is Aussie dollar weakness and also gold price weakness.
Your thoughts? Who do you side with, Scott or Mike?
Well, the banks are overvalued. There's three key reasons that have kept valuations up this high and the banks performing well. First of all, they've been a yield play, so the high dividend yields in a market where the cash rate is falling has certainly been supportive for the share price. In fact, if I just bring up a price of what's considered the most expensive bank in the world, and that's CBA on the top and cash prices down the bottom, and if I overlay the two, this is a 5-year chart, you'll see that while cash rates have been falling, CBA share price has been rising. So no doubt that the yield play is a big part of what's happening in terms of the bank's share price at the moment. So if you do see bond prices starting to fall and yields starting to rise, that would obviously be a case for some of the money to disappear from the big four banks. If we also have a look, Australia has performed relatively well to other economies during the global financial crisis, and there has been a lack of safe haven assets. So I think that's a key consideration as well. So if you do see the domestic economy starting to slow, then that could be a negative for the banks. And the third is the Aussie dollar. We know that during the global financial crisis, and while there was quantitative easing, we saw the Aussie dollar strengthening, and overseas buyers and sellers, which tend to be the marginal buyers and sellers in the market, while the Australian dollar is rising, that's great news for their investments while they're in Australia. But the opposite is true. As the Aussie dollar is falling, it's not so good for their investments. And I think this hedge fund in New York that everyone's been talking about on Monday morning, their view on the banks was because of the view on emerging markets and just seeing the Aussie dollar as a proxy for growth in this region. So if we do see a sell-off in terms of emerging markets, that could enter into weakness for the Aussie dollar and weakness into the banks. So no doubt banks are overvalued. Three key reasons why they have been doing well. That is, they are a yield play, the domestic economy has been doing relatively well, and the Aussie dollar has been strengthening. And if we do see a reversal of those three conditions, then we could see some of the steam coming out of the banks. I don't think we're going to see a crash though.
Yeah, I was going to say, Julia, I mean, how much downside risk, if all these negatives come to pass, how much downside risk do you think there's in the banks? I mean, it seems hard to see CBA falling to $50. At some point, I would have thought demand's going to kick in when people see sustained falls in some of these big banks?
I guess when we have a look at some of the short positions in the market and what they're hoping to achieve, they're really looking at falls of about 10 to 15%. So while these are significant, I guess in terms of the yields and the level that many investors have gotten into the banks, it's really dependent. But of course, the banks have had a fantastic ride up. A lot of people bought CBA at the IPO and haven't even disposed of shares, so around that $5.40 level, which is pretty much less than the dividend of CBA now. So I guess the banks have always been a favourite with Australians. I think they are very much in favour because of the yield play and the impact that low interest rates have had on this market. And I think as interest rates remain steady here in Australia, and perhaps the expectation of the interest rates starting to rise will mean that bank prices will come back, but we're looking at around about the 10 to 15% mark.